Welcome to our Taking Stock video for the week ending the 19th of May, 2023. I'm Kien, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz, to trim to you all things share market. Welcome, Matt. How are you and your family?
Going well, thank you. And it's good to be joining you, Kien.
Great to have you on board. But before we start, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile, so any charts and performance tables presented shouldn't be relied upon as a guide for future performance. Well, Matt, the Australian market, it continues to trend sideways as it absorbs the prospect of further interest rate hikes and more political theatre regarding the US debt ceiling. And this week, the minutes from the RBA's meeting reiterated that further interest rate rises may be required, with the futures market now pricing in a 58% probability that the cash rate will rise by August. And that's up from 20% the week earlier. Now, this was further compounded with wages data as well, which revealed a stronger than expected annual rise of 3.7%. And that's putting further pressure on inflation.
And meanwhile, in the US, increasing the debt ceiling once again dominated financial media. And it's the usual suspects within the Congress that are turning it into, as you described, Ken, a political theatre. I've lost count of how many times we've seen this song and dance play out over the last 20 years. And at the risk of sounding a bit flippant, I'm not stressing too much about the story because we simply have to assume that the politicians within the Congress understand the seriousness of defaulting on their debt. So the consequences would be quite large, but the probability, in my view, is extremely low. So it's not really without irony, is it, Ken, that these are the same politicians that have passed the spending bills that have put the debt position to where it currently stands, and now they're threatening the creditworthiness of the country for political point scoring. We'll do what we always do and try to separate the facts from the noise, but the likely outcome here is that a deal will be reached and that concessions are likely going to have to be made for future government spending initiatives, and this may weigh further on economic growth prospects. But our focus will remain on the fundamentals of businesses, and if volatility does spike around these specific events, we'll look to exploit those opportunities as they present.
Yeah, that makes a lot of sense, Matt. In fact, in the 2023 Berkshire Hathaway annual meeting, Warren Buffett did highlight that he has invested around $40 billion in recent weeks, including significant increases in his holdings in energy company Occidental Petroleum and also computer hardware company HP. Interestingly, though, he believes that there is significant risk still with the banks, with many exposed to the commercial real estate sector, which could struggle on the rising interest rates. So he has moved out of several financial stocks in the first quarter, including US Bancorp and BNY Mellon. So quite interesting.
Yeah, and with those significant cash amounts on the sideline, he does remain optimistic that the ongoing volatility in banking could present opportunities later down the line. So similarly to how we're sort of positioning at the moment for our Lincoln managed growth funds, both here and in the US, we're sitting on cash positions of approximately 25%. So we continue to believe that markets have not quite priced in a risk to earnings with the economic slowdown we're expecting in the second half of this year, rising interest rates and the drop in consumer spending. So we are obviously positioning somewhat defensively to take advantage of opportunities down the line into the second half.
Yeah, you spoke about the poor or weakening consumer confidence, and this is feeding through into corporate earnings. In fact, we have begun to see a downward drift to forward earnings estimates for the market, as shown with the chart on screen. And the earnings estimates are highlighted in black, and you can see the S&P ASX All Ords Index, that's in blue there. Much of this downward revision, though, has been driven by the banking sector, which is facing intense net interest margin pressure from rising competition and higher funding costs, Matt.
Yeah, I think the real sensitivity, Ken, is to bank profitability and how that plays out with regards to the severity of the bad and doubtful debt cycle. So that'll ultimately begin to rise if unemployment levels continue to rise from the current low levels that they're currently sitting on. So, of course, we will be monitoring the banks quite closely, especially if payout ratios are continuing to rise. which in our view will be putting dividend sustainability at risk. So for now, we've retained the banks in our Star Income stock universe due to the unstretched payout ratios and the attractive yields you're currently getting. But as we said, we'll be monitoring quite closely. And speaking about negative earnings revisions, fertiliser and explosives manufacturer Incitec Pivot released its first half 23 result, which did miss operating earnings expectations by some distance. And this was driven predominantly from their fertiliser manufacturing and distribution business, which was impacted by the decline in fertiliser prices. So given that we are observing some earnings risk and potentially a negative outlook, Kien, why did Daniel retain it as a borderline star growth stock?
Yeah, that's a good question, Matt. And if we look at Golden Rule 7 and we see the earnings breakdown, it shows that the explosives business, that's where it generates the larger portion of its earnings. So this area is benefiting from mining volumes and also growing customers and better contract pricing. In addition, remember, fertilizer prices, they are expected to improve in the next 6 months as agricultural markets and farmland recover from flooding. In addition, you've got also the winter planting season too. So we expect that fertilizer segment to improve as well. Hence, we feel that this was overlooked by the market.
And furthermore to that, Kien, the company is highly cash generative and has launched its $400 million share buyback program, which should support its share price further. As always, investors should consider the active risks such as exposure to fertiliser prices before making an investment decision. And another highlight this week comes from Star Growth and Income stock, AUB Group. And this is the insurance broker, which announced a capital raising before market yesterday. So last year, if you can recall, the company announced that it would acquire UK-based insurance broker Tysers Group in a joint venture structure. But yesterday, the company announced they'll no longer proceed with that joint venture to purchase Tysers, but rather they are going to acquire 100% ownership themselves.
Wow, they want to take 100% of the business, Matt, but now they have to fork out an additional 100 million to fulfill that funding gap that was meant to be paid by the previous joint venture partner, PSC. So to satisfy this, management has called for a 150 million equity raising, and a portion of those funds is also used to strengthen its balance sheet as well, because if you have a look at the financial health, that has kind of deteriorated slightly, moving from strong to satisfactory last period. But positively though, AUB has also lifted its financial year 23 earnings guidance to be about 4% higher on a midpoint basis. And this should lead to further earnings upgrades to the growth rate, currently at around 24%. This upgrade was supported by robust volume growth across the business, along with the inflation-driven rising premium rate cycle.
And onto the corporate calendar. One Star stock will release their interim results next week, and that's borderline star growth stock Technology One. The company was recently the victim of a cyber attack, and despite this, the stock has been on a run lately, up almost 50% on a full year basis, trading at a 9% premium to its consensus share price target.
So in Under the Microscope today, we take a closer look at prominent casino and online gaming operator Aristocrat Leisure. Its first half result, it looked quite solid with revenue growth above market expectations. But historically, Aristocrat's share price tends to run up hard prior to its results, only to be sold down on the day. And this time, it was no exception here, Matt.
Yeah, no exception there, wasn't it, Kien? It was down quite substantially on the day. But prior to the first half result, management did announce the acquisition of a company called Neo Games, and they're an online gaming company that involves real money bets into casino games, poker bingo, and sports betting. So Aristocrat's digital gaming segment currently makes up some 43% of group revenue now.
Yeah, this area appears the driver of growth, but it also comes more than a year after Aristocrat tried to buy rival gaming software firm Playtech, which was knocked back by the target shareholders. But we believe this deal has less risk because the size of Neo Games, it represents only about 7% of the market cap of Aristocrat. In addition, the deal will be fully funded by existing cash levels, and unlike the potential acquisition of Playtech, where significant debt was used, this deal should not impact the strong financial health of the business.
And remember, after the failed bid for Playtech, Aristocrat did amount significant cash as a war chest of sorts in that $1.3 billion equity raising that they undertook for that acquisition. So this did lead to some level of dilution of the group's return on equity, but the company is now taking steps to turn this all around. In fact, on top of this acquisition, management has announced an additional $500 million on-market share buyback, which should support the share price and profitability metrics moving forward.
Yeah, quite a few buybacks happening there, Matt. But management is hoping the acquisition of Neo Games will accelerate its growth into that digital gaming space. The purchase price for Neo Games was not cheap, though, at around 15 times earnings multiple. But really, the X factor here is that Neo Games' substantial exposure to iLotteries, which currently has about a 67% market share in the US. And this should complement Aristocrat's business and lead to positive earnings contributions from financial year 25.
And despite the strong rally in the share price over the past 12 months, the stock still continues to trade at a discount to the consensus price target, which could be revised a bit higher on the back of a solid result. The stock continues to trade well below its highs at $50, so this could represent an opportunity for investors who believe in the growth of the online gaming market.
But as always, Matt, those who are trend sensitive will need to wait for the stock to trigger an entry signal on the SD30 TSR. With rising interest rates and slower economic conditions, we have noticed a rise in short interest across the retailers and some regional banks. So a useful question this week for members is, what is short interest and how can it help you with your active risk assessment on a stock?
Okay, so to put it simply, short interest represents the proportion of the market, mostly hedge funds and institutional investors that are placing bets that a stock price will decline into the future. So when investors are short a security, they're essentially borrowing the stock from what we call prime brokers and then selling those shares on market, with the anticipation that they will be able to buy those shares back at a cheaper price at a later date.
Yeah, quite interesting there, Matt, but very technical. So let's go through an example. Let's take a look at, say, Zipco, a buy now, pay later payments company. Its financial health is currently in distress, and with declining revenue growth in the past 3 consecutive periods, I may choose to short the stock because I anticipate the share price to fall. So short interest here may be used as an indicator of market sentiment, with an increase in short interest signaling that investors have turned more bearish and vice versa.
That's right, Kien. And you can find the short float percentage, which is the number of shares sold short divided by the number of shares on issue, in Stock Doctor under the Golden Rule 4 section. So let's view the Zip example. And if we click on the drop-down menu and select percentage shorted, we can see at the bottom of the chart here the historical short interest.
Yeah, that's right, Matt. And you can also see that currently there's approximately 10% of shares are being shorted, which is a very high number of active short positions. As a rule of thumb, a stock with a short interest, say above 5%, should be investigated thoroughly. In this case of Zip, though, the high levels of short interest in 2021 was a precursor to the significant decline in its share price.
But one thing to also note, Kien, is that a stock with very high levels of short interest could lead to significant share price volatility to the upside in what we call a short squeeze of sorts, and especially if the company defies expectations and releases a positive announcement. So when this happens, short investors will need to cover their positions by buying the stock back.
Well, very interesting, Matt, and that's all really we have time for. But if you have any questions with today's episode, remember, feel free to participate in our Link Alive webinar this Monday. But again, thanks, Matt, for your valuable insights today.
Always a pleasure, Kien, and thank you for having me.
And with the end of financial year approaching, it may be a good time again to introduce Stock Doctor to your family and friends so that you can take advantage of upcoming promotions. You can either do this by refer a friend tab or send a link to the free trial page as well. But to summarize really today's episode, the market appears to be concerned about rising interest rates and the US debt ceiling. but we need to really separate the facts from the noise. Remember, invest in the fundamentals of the business and take advantage of market volatility to look for exciting oversold quality opportunities as they emerge. Take care and have a happy, healthy, and prosperous week, everyone.